Real estate investment practice problem using Excel. Adjustable rate mortgage or ARM with rate cap part 4. Get ready because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we have 3 tabs down below: example, practice, and a blank. Let's take a look at them now, starting with the example tab, in essence being an answer key. We started out looking at the standard fixed rate 30-year 360-month loan and the related amortization table so that we can compare and contrast it to what we are working on now, which is going to be the adjustable rate or ARM. This problem being slightly different than a prior problem in that we not only have the adjustable rate, but we also have the limits, including the annual rate limit, lifetime limit. We then thought about the index in our table up top, the index being, in essence, something we don't know up front, but the basis that gives an idea of what's going on in the market. And then we're basing our rate off the index with a margin, which would be this column of the margin of 2% above the index. But we had to apply the caps, including the annual cap and lifetime caps. Therefore, the rates that we actually use based on this data is here. Then we calculated the payment calculations and the ending balances, doing the ending balance in 2 different ways. We also looked at the rate change in terms of a schedule or a chart on down below, looking at the red line, the blue line, those being the differences from the margin, and then this gray line representing what's actually happening once we apply the caps that are involved. And now we're going to be looking at the cash flow calculations, which we can pick up from our table here. We can also create a pivot table, which we will create, and then we can think about our IRR calculations and see how we can use those tools to run projections with this. So we're going to then go to the second tab. This has our pre-formatted information in blue, pre-formatted cells, so that you can work through the practice problem and do a little less formatting in that area. Blank tab, this is where we started from one little scratch, and then we're going to make everything from scratch, formatting and everything. So then we got our information in the table that we've done thus far. We got the balances over here. Now we want to think about the cash flow, and we could do our calculations for the IRR because, of course, we have these changing rates that are taking place. And we want to think, well, what is the actual rate? And note that this is the kind of calculation when you're starting the loan or when you're into the loan, you're probably making projections into the future and trying to say, what's the best case? What's the worst case scenario? What's the likely scenario? How long am I going to have this loan? Am I going to refinance the loan at some period of time? Am I going to sell the property? Am I planning to do that? And in those events, where will we be in terms of cash flow given those events? Now, this one's a little bit safer given the fact that we have these caps. So if you have a worst case scenario with the caps, then you got this lifetime cap in this case, so you can't go over 16% in this case at least, which again, it would depend on the environment as to whether those rates are going to be high or low. So it would depend on the circumstances at the particular economic time. But you got those caps that should give you some borders and a little bit less risk than if there were no caps and the adjustable rate. Okay, so let's do our cash flow in our table real quick. I'm going to start this one with the first one. It's going to be, I'm going to make the inflow basically positive. That means that that's the money we got from the loan on a cash basis. We didn't actually get it, but we can imagine the financer giving us a loan of $100,000. We take that and pay it to the seller for the home, and then we're making payments. The payments are going to be equal to these payments, and these are payments for each of the years for 5 years. So I'm just going to take those payments times 12. This will equal this number, the 952.32. I'm going to make it a negative of that number times 12 would give us yearly payments of 11,428. That's the cash outflow that we would be paying in year 1. If we took Phil's handle and dragged it on down, then we got the payments that would be made for the 5-year period, multiplying each of the payments times 12. The last payment, if we're saying that we're going to close this out after 5 years, we would have to close out the payments, and then at the end of the year, we'd have the balance of the 9811. We'd also have to close out, so I'm going to add that into the end, minus the 9811. And there we have our cash flows if we're thinking about this and saying we're going to close this thing out after 5 years, even though it's a 30-year loan. Then we can calculate the IRR, the rate at which this series of cash flows would be 0. And that's kind of our average rate that we can kind of think about. But the IRR is more accurate generally than the average rate, especially if we had different time frames up top than the yearly time frames. So it takes into the time value of money calculation involved. However, note here that we're doing a bit of an estimate, because if I look at these totals for this 5-year time frame, each of these cash flows are expected to happen at the end of the period. That's how these calculations work, when in actuality they happened in 12 equal payments through each year. So it's a bit of an estimate, and then we'll do it a little bit more without the estimate with on the right-hand side from the amortization table. But this is a nice quick IRR calculation equals the IRR, the internal rate of return. And then we just select this column of data, and it's already in years. And then we'll make that a percentage number group, percentifying it, adding a couple decimals. We're at the 12.81. So that's kind of like the average percent. Like you could try to say, what if I took the average of these items? Or let's just calculate the average so we see what we're doing. The sum of these divided by 1, 2, 3, 4, 5. So we're gonna say the sum of those divided by 5, making it a percent. Let's do that again. Something funny happened. Equals the sum of these, closing it up, divided by 5. There we go. 13 about. Now again, this one is usually going to be more accurate, especially if you were to have different time frames that you're taking into consideration. But you can think of it kind of, in a similar fashion as like an average rate, since we have these multiple rates throughout the loan for the 5-year time frame. Now, you could also take this information and think about best case and worst case scenarios, looking at the cash flow and what your ending balances will be, which could be a little bit easier if you add a pivot table. So we'll add the pivot table. Now, note that this does give you a pretty good idea. It gives you the payments, and we can make the payments into a yearly, and it gives us the ending balance. It doesn't give us like the interest for each year as easily, which might be useful for tax calculations. It doesn't give us exactly the reduction, although we can kind of back into that. But the pivot table then might be useful to add so that we can get that added information and not have to go through the entire amortization table to do it. So we've done this a few times in the past, so I'll do it fairly quickly. But we're going to put our cursor in the table. We're going to go to the Insert tab up top. We're going to go to the Tables, go to the Pivot table, and then I'm going to add this in the existing worksheet, right there. And then I'm going to put it in not in like this cell, in AC1. So blank AC1, and OK. There we have it. I'm going to scroll over to the right. Now I'm going to make this a little bit pretty quickly because we've seen it before. I'm going to close this cell up a little bit. So we got less space there, not wasting space. I don't like wasted space. So then we're going to take the years, pull that on over to the rows. So we got 30 years. And then we're going to take the payments, interest, loan balance, loan reduction. We're going to do our standard formatting so it doesn't look all crazy with the formatting with all these decimals. We're talking dollars and cents here, people. Make it look right. So we're going to go to the sum thing drop down, and then value field settings. And let's just do our standard value field settings number format. And we're going to say, I like to go to currency, bracketed, no $, no decimals. Okay. Do it again for the second one. Value field settings, number format, currency, bracketed, no $, no decimals. Okay. Let's do it again for the third one down. We're going to say, give me that thing, value field settings. Going to number format it. Currency, brackets, no $, no decimals. Okay. And the last one has a twist. There's a twist on the last one, you'll recall. So we'll do the last one down here. Value field settings. That's not the twist. Here's the twist. We don't want the sum. We want the minimum balance at the end of the year. Then we do the standard format setting. The twist is over now. This is the normal stuff. currency, brackets, $, none, no decimals. Okay. Okay. And then we can do our formatting. Let's put our brackets around this. Bracketize it. It's been bracketized. So we're going to go, or borderized. Home tab, their font group, their borders. That's what they're called. It says right there. They're not brackets. What are you talking about? Borders. And then we're going to go to the font group and let's bold it. And then let's center this column maybe. Center. And then let's do the black and white on the headers. Go in black and then go black and white. Let's make it black and white. So there we go. And one more. Hold on a booger picking second here. We got to do, okay, alignment. We're going to then wrap the text, and it's centered. And then we can squish these together a bit. Squish these together. This isn't centered. You call that centered? I'm centered. I'm completely centered. Oh, focused. Okay. So here we go. Then we can take that and we can think about basically our IRR calculations just to get an idea of the IRR. Now remember, you can have a bunch of different scenarios if you're taking on this kind of loan. You can compare it to a normal loan. You can compare it to different loans that might have the caps or not, because you would think then if they're going to give you these caps, then they might, have less favorable terms, in terms of rates, because they're reducing the risk, right? They're reducing the risk. They're making it less variable, so you can compare different loans like that. You might have different comparisons on terms of how long you're going to have the loan outstanding, worst case, best case scenarios. And so let's just run some IRR calculations, which this is one that gives you the time value of money calculation to do that, just to work with our formula. So we'll run one out for the entire time frame first for the 30 years, even though we've only calculated this out for 5 years. But given the 5-year information, if we took it out for 30 years, what would be the IRR? So we're going to say the ARM. This is going to be the cash flow. So I'll just name it that. Let's make it black and white up top. We're going to go font group, black, white, center. And then let's go say this is going to be 0, 1, 2. Selecting those items and dragging it on down with Mr. Phil's handle. I'm not sure if Phil's a doctor or not. We'll call him Mr. Phil, Dr. Phil. I appreciate the creation of the handle, whether Phil happens to be a doctor or not. The Phil handle is an excellent tool that has been created, and we're all appreciative of it. So we're going to say 360. We're then going to center it. Cash flow is going to be equal to the 100,000. Let's pick it over here. And then the outflows monthly now, instead of the yearly outflows, are going to be the payments of the 952, and then they'll change to the 1,028 and so on. I'm going to do that by doing the fill handle button click, and that goes it all the way down. So then it changes to 128, and then it went up to 1336, and then it went up. And that's all it went up to. And then we're taking that all the way down, even though there might be changes beyond that point, because that's all we have the data for. So we're still going to take it down 360. Let's see the total, what would happen in the total if we were to make that assumption. Summing this up on the cash flow. And then we'll take a look at the IRR, the rate at which this series of payments would be 0 equals the IRR, brackets. And then just taking this whole series of data again. I'm just going to hit enter. That would be on a monthly basis. Number group, percentifying, adding some decimals. We want it on a yearly basis, so I'm going to double click on it, take that thing times 12. So we're at the 12.42 if we were to take this out just with the data we have for the 360-year time period. Notice that's a little bit, 12.81 is what we calculated just over the 5 years, stopping it at 5. Let's do it again. This time we're gonna twist it somehow. We're gonna put a twisty in it, and we're gonna say let's just take it out for 3 years, for a comparison. 3 years. What if we're saying, well, what if we only have this thing like for 3 years? Then I'll copy it. Let's copy this. 3 years is 36 payments, 3 times 12. So I could say if this is what we think is going to happen for 3 years, I'll just cut this off down at 36 payments right there. And then I'm just going to remove everything under that. This probably wasn't the fastest way to do it, but that's okay. It's a way to do it, and it works. It works, okay? And then the ending balance here we'd have to take from our table. So that's the amount that we'd have to pay, but we'd also have to pay off the loan balance if we stopped it after 3 years. So we're at that 98835 minus the 1181. So there's that last balance, the total. If we were to total it, totally total it, total totes. And that's going to be that. And then we'll take the IRR after 3 years, the rate at which that series of payments would be 0. So what if we were just planning on wrapping this thing up in 3 years, and this is the scenario that we're saying is happening at this point, and we're comparing it possibly to other investment opportunities. What in the world? That's the sum function. Hold on a booger picking second. I'm looking for the IRR, not the sum. So we'll take the IRR, closing up the brackets. That would be on the monthly number group, percentifying monthly rate, multiplying it times 12 to get the yearly rate. So there we have it for if we were thinking about it like for the 3 year based on the information. Obviously, if we change the information on the left, this will populate automatically so we could see those changes. Let's do it again for a 5 year, and this will kind of verify or double check the IRR we did quickly here, but we made it based on a yearly format instead of a monthly format. So let's do it again. I'm going to copy this first one because it's got all the way down. Let's copy this one. Copy that. I'm going to paste it right there. This was for 3 years. Let's put that in here. A little more detail. And then center that so we know what's happening. Got to tell people what we're doing around here. Otherwise, what's the point? What's the point? I just like doing stuff, all right? That's the point. No one needs to know what is... No, you got to label it. We got to label it. So this is going to be going down to 60 payments. 60 payments because it's 5 years. That's 12 times 5. Otherwise, calculated as 60. We'll just delete everything underneath that because that's past the 5 year point that we're focused on. We're totally focused. We're totally centered. So we're going to say that. And then we're going to take the 60 here, and that means we have to pay off the loan balance at this point. So we'd have to pay off the loan balance, which would be the 9811, and that last payment of the 1033. Let's totally total it. Total equals the SUM, shift 9, pulling that up to the top, taking our flow of the cash. And then we'll take the IRR, the rate at which the series of payments would be 0. IRR. And that would be the monthly. That would be monthly percent, adding some decimals. We want the yearly, double clicking on it, multiplying it times 12. There's the 12.83. We can compare that to what we got over here with our quick IRR, which was 12.81. So it's pretty close. Let's reconstruct this one from our table just to get practice of, using our amortization table, which of course you can use for yearly information. You might want to pull like the interest from it, for example, for tax purposes or something like that. But just let's practice our IRR on a yearly basis. So I'll do this one more time just for the fun of it, because it is indeed good times. Can't imagine what else you'd want to be doing at this point. Years cash flow. Let's do this on years cash flow. And then I'll center this or wrap it and then make it black and white. Center. And now we're talking years now. Years 0, 1, 2. And then I'm going to autofill it down because I don't want to type the last 3 numbers. I want to fill them in with autofill, even though it might even be slower to do that. But whatever. So we're going to start off with 100,000, and now we got the yearly payments, which we can see on our table here for the 5 years. So we had the sum of the payments are 11,428. So I want to pull that information over to the right side, but I don't want to reference the pivot table, because then when I change the data, it might change our data over here and mess up the scenario. So if I'm using the pivot table, I got to use kind of hard-coded numbers. I also want them to be negative when I put them here, and they're positive over here. So here's our little tricky thing. We're going to do some fancy business. We're going to select these, and we're going to copy it. And then I want to paste it over here. I'm not going to paste it where I want it to go right now. I'm going to put it down here somewhere. And I want to paste it just the values only, so it doesn't put any kind of cell references or formulas in there. So I'm going to paste it 1, 2, 3, just like that. And then I'm going to copy it again. And then when I put it here, I'm going to do some special pasting. Pasting it special. Not even one of these like specials, but like super special down here. We got to go to the other options. And then we're going to go to the subtract. So we want to subtract it, put them in there as negatives. So there we have it. Looks good. Then we can total that up. Total equals the SUM of these items. We can take the IRR, this time on a yearly basis. So this is that same estimate that we're doing before. We're basically, assuming these cash flows are happening at the end of the period, when in actuality they're happening on a monthly basis. So this would be the IRR of this flow. Hold on a second. I also need the ending balance. Hold on one booger picking second. That last balance right there, that 12, we also have to have the ending balance of the 9811. 9811. So I'm going to subtract out the ending balance minus 98011. And there we have it. Let's try it again. So this will be a percent. And there's a 12.81. So that 12.81, in essence, we just recalculated what we did over here, 12.81, just to see how our tools are working and so on. So those are the tools. Let's do some formatting now. Let's do some formatting, make it look nice. I'm going to select these cells, holding down Control, looking at these columns, picking up these columns so that we can format them at the same time. There we go. Let's put an underline right there. A line underneath the text, sometimes referred to as an underline. And then we'll make these blue and bordered. So we'll go to the font group and border blue. Then we'll select this whole thing and border blue that one. Border blue. This one, I'm going to border blue this one, because that's what we do here. Border blue. And then this one, yes, we're going to border blue it. You thought this last one we were going to make it red or something, but no. Once again, border blue. Okay, got to keep consistency here. Consistency. And then these last ones, let's do that one here too. Border blue. Border blue. And there we have it.